somebody's coming in with money. Okay. I know what you're talking about. And I know there's ways to kind of like reverse engineer the residential stuff to look a certain way just to get the right LTVs or seller carries and all this stuff. Then, there's the BRRRR method, right, too, which I would not recommend anybody do, is leveraging themselves up as much as possible. But, I mean, I get calls about this all the time, too, right? Hey, I need a 50% LTV loan. Okay. What's the purchase price? $2 million, but it's worth $4 million.
Hi, everybody. Joseluiz Morales here. Welcome back to another episode of the Morales Group Show. Today, we have Jake Clopton out of Chicago, Illinois with Clopton Capital. And today, he is going to be explaining to us how a commercial loan works. We're going to be going over commercial mortgages and financing. And then we're just going to be explaining just the very basic levels as to how commercial loans differ from residential loans, how to underwriters underwrite properties, and then even talk about just different asset classes. So we'll be talking about like mobile home parks, multifamily, self-storage, and how the financing varies. Welcome to the show, Jake. How are you?
I'm great. Thanks for having me on. Appreciate it.
I love it. Thank you.
Well.
So for our viewers who don't know who you are, who is Jake Clopton? And then how did you get involved in this wonderful world of commercial lending?
Sure. Yeah. No, I appreciate it. I can rewind time a little bit. So about 15 years ago, I started this company. Before I started this, I traded interbank hedging product futures, which is a fancy name for 3-month LIBOR and Fed funds futures, stuff like that, and treasuries. And if you kind of look back in time, 15 years ago was, the financial crisis. And so that business kind of went away in a hurry. So I was thinking of trying to figure out something else to do. And, at the time it was a lending crisis, right? And my idea was to create an intermediary type of deal that focused on, business financing for small to middle market companies. And then taking, somehow capturing transaction costs between the borrower side and the lending side. And so what I really did at the time, and it was just me, is I just started cold calling lenders, and I just made a couple phone calls a day and found money. And, back in 2009, if you found money, people would just come because there wasn't anybody, lending at the time. And that kind of turned into our operation today. And today, I run all of our commercial real estate capital markets. We do debt, perm bridge construction. And we also do some higher cap stack stuff like mezz, pref equity, and limited partner joint ventures. Nothing that looks like a real estate security. All asset classes, almost pretty much nationwide. And we also have a couple other divisions. We're a commercial property insurance company, and we do fractional CFO work. And we just started up with solar installation services. So it's all commercial real estate services. But as I told you before, I don't run those sides. All I do is capital markets, and I focus on that.
Got it. So I'm going to start off with a funny question for you. How do I get pre-approved for a commercial loan?
If you figure that out, let me know. You don't really, right? So okay, we can just jump on this. So that's one of the, when somebody calls me up and says, how do I want to get a pre-approved for a loan for this apartment building, I immediately know that they're coming from the residential kind of world, and they haven't done a commercial loan before. And because there really is no pre-approvals for commercial lending, right? When you go and you get a residential Fannie, Freddie, FHA, whatever it is, residential mortgage, just goes to show you how much I know about residential mortgages, right? You get your pre-approval, and it's based more on you as the person, right? And then you can go look for your property, your house, whatever it is. So it's underwritten mainly on the person themselves. Commercial is completely separate of that, right? I mean, and it's backwards. Whereas in residential, you start with the person, then you go to property. Whereas commercial, you go from the property, then, kind of look at the sponsor and what they have going on. So this happens, over and over and over, Jose can't tell you how many times in the past 15 years that, people call up and they say they want a pre-approval without having, even identified a property or knowing anything about it and all this stuff. To even have an idea of what the rate's going to be, the terms, the loan amount, all this stuff, I have to fully underwrite the cash flows of the property, right? So when you're looking at commercial, the primary repayment source is the property itself, right? This is a great way to look at it. Primary repayment source is the property itself. Residential, they're looking at you as the primary repayment, right? Your personal income of the property. And that's why you get the two different, points of view, depending on if you're residential or commercial. So.
Got it. Now, you mentioned that you guys take a look at the sponsor. What is a sponsor as it relates to commercial loans? And then what happens if you don't have a sponsor?
The sponsor is just you or I, right? Like whoever the main person is in the deal. And that's kind of like our nomenclature for the borrower. Even though like in commercial though, like there's levels of ownership. So what I would call the sponsor is the warm bodies, like the actual human beings behind it. And the borrower is actually the LLC that holds title to the property.
Okay. Perfect. So how do commercial loans somewhat differ from residential as it relates to are they 30-year mortgages? Do they have variable interest rates? Are they interest only? What typical loan to value ratio do they typically go?
All good questions, right? So yes and no to all the above, and yes in variations, right? I mean, the biggest difference between commercial loans and residential loans is like residential loans are kind of built to be somewhat uniform, right, across the industry. They're somewhat commoditized, right? I mean, the typical residential loan is a 30-year fixed, 30-year AM, right? When you get into the commercial space, which I think most residential investors call these like DSCR loans, right? I mean, they're kind of painting the picture for you, right? Because they're underwritten based on the cash flow of the property, and they come in all different sizes and shapes. Depending on who the lender is, what the property is, all this stuff, you can get, some interest only. They typically go up to 75%, maybe 80. 80 is like the high side. I'd say 75 is like the down the middle kind of leverage. Typically 5, 7, or 10-year fix. And amortizations vary. And usually that 5, 7, or 10-year fix is also coterminous with like the balloon payment of it. So for instance, maybe it comes due in 5 years, or maybe there's a rate reset at 5 years, or if it's a 10-year fix, it probably balloons at the end of 10 years. Depending on who the lender is, will be if they're willing to go out to a 30-year amortization. So yes, there's 30-year amortizations. I would not say there's as many 30-year loans, right? And there are certain lenders and products that do a 30-year fix, but typically those rates are so high, nobody really does them. You typically stay on that like medium side of the curve, on like a 5, 7, or 10-year fix. Now, if you're doing something like a rehab deal or some construction or something like that, you're going to be much, much shorter on the shorter end of the curve, and have a variable rate attached to it. That variable rate would be most likely based on either prime or SOFR. SOFR is the new LIBOR, basically. So it would be based on one of those two. So lots of different ways to slice and dice commercial loans versus residential.
Got it. So I know you mentioned that on a commercial loan, you can't really get pre-approved. It really depends on the property. So let's say somebody identifies a property, but they've never had a commercial loan, but let's say it's a great property. Will they automatically qualify, or will they need a sponsor to help them sign on to the debt because maybe they don't have management experience for like a large apartment complex?
The answer, as usual, is it depends, right?
Mm-hmm.
Depends what they're buying. Okay, so for instance, here's a good example. I had a guy call me the other day. He said, hey, I'm looking at this building in Chicago. It's got a $70 million loan on it, I can assume. And I'm looking for equity. Okay. So it's like $100 million acquisition. Yeah, sure. So what's your experience? Like, what have you own anything? Yeah, I've owned a couple residential investment properties in the past, like single family homes. It's like, that's kind of a big step up, So, I would say that's one of your more extreme cases, but it's easier to explain things in extremes, right? If let's say you're a guy that has a portfolio of like 10 kind of 1 to 4 unit properties, you self-manage all of them, you're going to buy a 10 unit. Sure, man. I mean, that makes total sense, right? As long as you're not basically going broke for the down payment of the property, I don't see any problem with that whatsoever. If you're a guy that's owned 2 single family homes and you're looking for a joint venture partner to buy a $100 million, residential tower in downtown Chicago, that's probably not going to happen, right? Like, so, there at a certain point, it's your personal experience level, like, just gets outdone by the asset class. A lot of this also depends on hey, is there going to be third party management, or are you managing it yourself? You know what I mean? Most residential guys are usually pretty comfortable managing themselves, and they want to take on, multifamily properties and manage those. I would scale up and start small and kind of move upward. Like, yes, even though you may manage 10 homes, right? An apartment building is a different animal. There's different mechanicals. I mean, different things go wrong, right? So there is a little bit of a learning curve, and I have seen people kind of get in over their heads in the past, even with smaller apartment buildings. The people that I've seen efficiently make the transition, scale up, right? They get a couple residential homes, they want to make a jump to commercial, they do a 10 unit, then a 20, then a 50, right? I mean, and it slowly scales. Trying to go right from 5 homes to a 50 unit apartment building and manage that, I don't think anybody's going to approve that.
Yeah. What about, does 100% financing exist?
No.
Zero.
No, doesn't exist.
What would be a way of structuring a deal where maybe you found the deal, but you don't come in with any money out of pocket?
Somebody's coming in with money. Okay. I know what you're talking about, and I know there's ways to kind of like reverse engineer the residential stuff to look a certain way just to get the right LTVs with seller carries and all this stuff. And then, there's the BRRRR method, right, too, which I would not recommend anybody do, is leveraging themselves up as much as possible. But in commercial, that proposition is going to be extremely challenging. I get calls about this all the time, too. Like, hey, I'm just looking for, 25% LTV on this building, or whatever, and I've got a 75%. No, not going to happen. Or, hey, I've got a seller that's going to carry 25%, and I need a 75% loan. No, not going to happen. The reason why is there's a very, very strong cost basis and cash basis consideration and skin in the game in the commercial space, right? And there's a lot more scrutiny on that than I think there is in the residential space, whereas like those deals are typically pretty small, and they kind of, I think sometimes that stuff happens because it just kind of gets through the cracks. Whereas in the commercial side, you typically are dealing with much larger numbers, and it's easier to pay attention more to that. And I think less of that kind of gets through the cracks. If you wanted to do a deal with no money in it, one, I think it's a pipe dream, but unless you have like a really, really, strong guarantor and syndicate out of the equity, it's still going to be a little bit of a challenge. Like, because even when I see deals that are syndicated, right? I mean, these are like, so when I say syndicated, I mean like somebody's going out and getting a bunch of high net worth guys and they're coming in with all the equity. There's like a GPLP structure where just like, you have your general partners, which would be like you, the guy that wants to come in with no money, right? and then the limited partners, which are all the equity guys. And the equity guys are usually not going to sign on recourse, right? The general partners would.
Yeah.
I still get pushback even in the scenarios where they have all the equity, but the GPs are not coming in with any money themselves. You know what I mean? Because
they want the GPs to have skin in the game, basically.
The skin in the game, right? So, I mean, that's the guy running the property, right? I mean, who's more likely to walk away from a situation that gets hard? A guy that's got skin in the game, or the guy that has no skin in the game? You know what I mean? That's the consideration there. And I mean, in the commercial properties, these are not just investments; these are operating businesses, right? So there's absolutely a cost basis consideration and a skin in the game consideration.
Got it. Now, are there lenders that would actually do that? Like, meaning, because I've heard of all these creative ways that people buy real estate. Like, they'll be like, okay, I'll get a first loan for 75%, and then the seller will carry back 25%. I'm at a 50% of the actual value. So there's 50% equity in the building. Yes, I'm not coming in with any money, but I've got all this built-in equity. Are there lenders that will actually do that? Or is it just...
I mean, I get calls about this all the time too, right? Hey, I need a 50% LTV loan. Okay. What's the purchase price? $2 million, but it's worth $4 million. No. I mean, an appraisal just a piece of paper. It's worth what somebody's selling it for, candidly. I'm not going to say nothing ever happens, right? Because I'm sure everything has happened at some point. Mm-hmm. But if there was a way listen, man, I've been doing this for 15 years. All I do all day long is talk about financing and loans and deals and all stuff. If there was a way to efficiently finance 100% of something, I would own so much property by now. Like, I would own half of every city in the U.S. You know what I mean? Because this is all I do. I don't think I've ever seen one single person do that.
Got it. Now, in a situation where, like, let's say you do have like limited partners where they're coming in with, like, let's say 25 or 30% of the money, like, what is reasonable to ask from a GP? Like, in terms of, like, how much skin in the game are we talking about that they would need to have?
So the typical, like, GP LP split is 90-10, whereas the GP is coming in with 10% of the equity, and the LPs are coming in with 90% of that. So if you need $1 million downstroke to buy the property, GP's coming in with $100,000. The LPs are coming in with 900, and that's a pretty typical structure. So, I mean, it's not that much of the actual cost of the property, right? But there needs to be some skin in the game.
Some skin in the game. Got it. Okay, good. Now, how does a commercial property get underwritten in, like, by a lender? Like, what does that process look like?
I mean, I'll try to make this as simple as possible. Effectively, you're going to take, certain underwriting kind of metrics, right? Like, you're going to impute, like, certain even if you manage the property yourself, you have to impute some sort of management fee into there, right? Take a market vacancy rate, and then you're going to get your bottom line NOI number. And the usual down the middle answer is it needs to underwrite at a 1.25 DSCR, debt service coverage ratio, and that's $1.25 for every dollar of loan payment that's due. And the way it'll be underwritten is at, like, usually like a little bit higher interest rate than the actual coupon rate of the loan, right? So they're going to underwrite it with a cushion. I would say that's the most down the middle way to underwrite a commercial loan.
Got it. And then, does your company do, like, nationwide, or is it only in Chicago?
No. The vast majority of the deals we do are not in Chicago. Even though I'm sitting here, I mean, we've been around for so long, and I've got a pretty large kind of online presence. I think if you type in commercial mortgage broker, we're like the top result. So we get deals all over the place, man. And we have different service lines and stuff too. So things just kind of come to us at this point.
I love it. Cool. What about for, like, what's typical in a vacancy factor? I know that obviously that's going to depend per property. For multifamily, what about maintenance? Is there like a certain number that you guys assume? Does that depend on the age of the building?
Right. I mean, for vacancy, I would say like the down the middle answer is like 5% vacancy. Um,
Okay.
and then, as far as like maintenance and all this other stuff, we typically apply like an expense ratio, which depending what the property is and where it's located, I see anywhere from like low 30s to 40% expense ratio. That's like typical. It kind of depends on what market you're in and, where it's located. I mean, certain things like property taxes and insurance and utility costs are much, much higher in other areas. Like around Chicago, we usually use like a high 30s. That's typically kind of, where it pans out. Depends on what the property is too, though, right? I mean, a lot of these like Section 8 properties, like I personally own, some like, kind of like lower income affordable properties, and the expense ratios on there, those are like much higher than like, let's say like a Class A luxury property.
Of course. I've seen it where some people kind of do like a per unit type of like maintenance. Is that done in the underwriting world at all? Like say, okay, like we're going to factor in like $300 per month per unit or $200 per month per unit. Is that not like, is that not practically
Yeah,
how it's
sometimes we'll
operating?
use that as like an underwriting like capex type of reserve, and apply that before you hit your debt coverage, right?
Mm-hmm.
So yes, it's typically like $300 a unit, and we'll apply that to like subtract that from the NOI as a capex reserve
Mm-hmm.
before, but not all lenders are going to do that. Some banks and credit unions won't really do that. They'll just use like the straight, repairs and maintenance numbers that are in there. When you get into more like, CMBS type lending, like just commercial mortgage-backed security, anything that's going to be sold, that'll typically be underwritten like a little heavier. So like Fannie, Freddie, CMBS, stuff like that, definitely, apply like that CapEx reserve budget.
Got it. So $300. What about like the management? Like, what's typical like to assume for a management fee on a multifamily? Because I know it'll vary per.
Depends on what it is, right? The larger the property, the lower the percentage management fee is going to be. If you are, if it's like a 10 unit building, I mean, I think you can get somebody to underwrite 5%, but realistically, I think if you go out there and try to find management, you're probably going to end up at 10%, somewhere in there, like 7, 8, 10%, something like that. Anybody who's dealt with, property managers, they come in different flavors.
Mhm.
Like for instance, my property manager does a 10%, management fee, but then they don't charge for leasing. Then other guys do a 5%, but they charge for leasing, right? So it's,
Kind of varies.
whatever. I mean, yeah, so it works well for us, but I would say like the down the middle answer is like a 5% vacancy factor. Is what you're going to see most often.
Or the management fee or the vacancy?
5%. So 5 and
The
5 for both.
management. Got it.
Yeah.
Okay, so 5 and 5 for both.
Yep.
Got it. And then you said it could be less for larger buildings. Like, let's say, what's considered a large building? Like 100 units, 200,
Yeah, 100,
1,000?
100 units. I'll sometimes see like a 3% management fee, something like that. But again, they're making up some of that 3% for getting the leasing and all that.
Got it. Love it. Okay, cool. Now, how does commercial financing vary, like for different asset classes? Like, I know that we've been talking about multifamily. What about like mobile home parks or self storage or retail locations? How does the underwrite? How does that differ at all?
So yeah, so for mobile home parks and storage, it's not going to be too dissimilar from the way you underwrite an apartment building, right? I mean, in each, you're dealing with assets that are kind of similar, right? You've got a lot of, tenants that make up the whole of the revenue pie. When you get into different asset classes like retail, for instance,
Mm-hmm.
you may, as opposed to, let's say the same, like a $5 million apartment building versus a $5 million retail center. In a $5 million apartment building, you probably have like, let's call it 40 different tenants that are paying rent. Whereas in a retail center, maybe you only have 5 or 6 tenants that are paying rent.
Mm-hmm.
And, to get people in your space in an apartment building, you have to pay them or not pay them, but you have to pay like a 1 month leasing fee or whatever to the sales broker. To get tenants into a retail center, you'll have to pay a lease commission unless you do it yourself. But then there's also things like tenant improvements, right? So like building out the space, those types of allowances that I don't think some people realize. And, there is cost to actually getting the tenant in there. Sometimes they cover themselves, they're free rent, or there's a lot of ways to slice it, right? So when you're underwriting, retail, you're probably going to take a larger vacancy factor, maybe closer to 10%. The actual DSCR you're going to use is probably similar, but some of depending on what it is too, the expense ratios will be off. Like in some of these retail centers, for instance, you get triple net rents. So the tenants actually cover all the expenses themselves as part of their lease agreements. So you may actually have no expenses as long as the tenants are in there. So expense ratios are certainly going to be different. And then, as opposed to, let's say, taking a $300 per unit CapEx budget, reserve, which you would for an apartment building, you're going to take CapEx plus TILC reserves. And TILC reserves be based on the market for whatever landlords are giving the market to get tenants in there based on some sort of per square foot basis. And then, the CapEx would be typical CapEx for whatever, type of property is. So it's just in each one of these properties, each one of them has, their own considerations for like how they generate income and then, how expenses are allocated and also which expenses are borne. And that's what's going to be those are going to be the factors of how they're ultimately underwritten.
Got it. How does insurance vary per, and this is good because obviously you guys do insurance as well too. How does the insurance vary per asset class? Like, are there any rules of thumb that somebody can assume, like for an apartment complex, as to what they can expect? Like if I'm trying to underwrite a deal, just to see if it makes sense and trying to think like an underwriter, are there any rules of thumb that I could expect for insurance costs?
Yeah, the biggest factor to insurance cost, what I see today, is not as much property type, but where it's located. Right? If you're in Florida, it is really hard to get insurance. Like just in general right now, like wind, hail insurance. I mean, think about it, right? I mean, insurance is, insurance against perils, right? It's not just insurance against like, hey, is somebody slip and fall on the property? Sure, that's the liability coverage. But the actual property insurance is really going to be dependent on like where it's located, what type of perils are in the area, and what the risks are. And I mean, just being in Florida, that's everything that's gone on, the hurricanes, the floods, blah, 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 right? So, I mean, that to me is probably the biggest, determining factor of what insurance cost is going to be. I mean, the other things are like what neighborhood it's in. There's just so much like locality, that goes into the insurance. And I don't run that side, but I certainly, know enough to be dangerous about it. Mm-hmm. And it's going to be, location. In the market today, and this is one of the reasons why we started the insurance side and what we do. Before, insurance was easy and you didn't realize it was like an afterthought, right? You get your insurance policy and then you would just auto renew and that was it. You didn't really think about it, right? Those days are over, right? I mean, there's so much volatility and, like entrants coming in and leaving markets in the insurance side that I think, in today's market, people should be bidding out their insurance every single year. Another thing that we see consistently happening in today's world is, when they go in for renewals, like insurance carriers are agents are basically waiting to I don't know, give it 2 days before the insurance is about to lap and hitting you with like 100% increase. So the cost double. Like, here you go, here's your renewal. So either take it or you're going to have an insurance lap. You know what I mean? And that's incredibly common right now. So what you really want to do is pay attention to, and this is just something nobody thought about before, candidly. Pay attention to when your insurance is coming due. And just because you have one insurance agent, that's taking it out, all the like there's so much differentiation between like one guy that does it, another guy that does it, another guy does it. All we do is specialize in commercial property insurance, and I'd had a guy to respond to so the guy that runs the insurance side, Drew Sutton, he had somebody respond to an email to them the other day, just flood insurance, for instance. His flood policy was like 130 grand. And he was like, yeah, we're just auto renewing. And we just put him in a different policy and saved him probably 40. So, that's a big deal, right? That's a lot. And that's literally just using a different agent that, had better outlets. So not everybody's created equal in these markets. And not everybody either really understands it. Like if you have an insurance agent that is also doing, your car and your health insurance, you probably need to get somebody that's more specialized. Back in the day, a couple of years ago, that would have been okay. But I think in today's world, you really need to pay attention to that stuff. You're going to get hit with really high insurance costs.
What about, do you guys do Airbnb as well too, or just,
we've done some Airbnb. So we'll do, our minimum loan amount is like $1 million, right? And, the way that we've done residential portfolios and Airbnb and stuff like that is, once they get aggregated to a certain level where we can do a portfolio. So yes, done Airbnb. Love Airbnb. I think one of the things that is a little, I guess not incredibly apparent when when people are running Airbnb portfolios is that they're really running a business and not a piece of investment real estate, right? Like if let's say I buy a house and instead of renting it out on a long-term lease, I decide to do Airbnb in it, right? Mm-hmm. That real estate is still worth the exact same thing. Mm-hmm. You know what I mean? Like just because you can't just apply like the general cap rate to it like you would if you were putting it on a long-term lease and say, okay, well, this property is now worth twice as much because I make twice as much from the property and the cap rate is X and yada yada. There's certainly business value that you've created because you are running a business, right? You're running somewhat of a hospitality company on this property. That type of underwriting with Airbnb is one of the bigger challenges kind of we have like going to this stuff, right? And the way that a lot of this underwriting works is you'll find, and I'm sure most Airbnb guys have found this out too, is that their income kind of gets dialed back to what it would look like on a long-term rental basis versus STR, short-term rental, Airbnb, right?
Got it.
So that's how we pretty much look at that type of income coming from residential, when guys are doing STR and Airbnb versus, long-term rentals.
Which I think is smart because that's almost like assuming like worst case scenario. Like what's worst case scenario? Like worst case scenario is you have long-term tenants because Airbnb,
right?
Certain cities have been known to have certain regulations against it or implement certain regulations where it becomes illegal or it becomes to the point where you can't short-term rent a property.
Right. Well, right. Put it this way. If the lender takes the property back, you're probably not going to continue running your Airbnb business out of it, right? So, then it's just a piece of property. And the value of the property itself never actually changed. Yeah, it was worth more to that borrower because they were running their business out of it, but the value of the property never actually changed.
Got it. How do appraisals work in commercial real estate versus residential?
They're more expensive and they take a lot longer. That's the easiest way to put it. Residential. How much is a residential appraisal? $500, maybe.
$500, yeah.
Something like that. Yeah. A commercial appraisal is going to cost anywhere from like $2,000 to $5,000, probably. Mm-hmm. And on average, I see them taking like 4 weeks. Whereas like a residential, that's the thing, right? Residential properties, they're pretty uniform for the most part, right? A house is a house and you can pretty much compare it easily and get a comps, to other houses. You can compare it on per square foot basis, how many bedrooms you got. Mm-hmm. Each commercial property, like every one of them is different. And it's hard just to like this is why like robo lending doesn't work very well in commercial because it is each property is different. The makeup's different of it. Like there's just so many more variables, and then like the sponsorship side matters more. So it just the commercial appraisals are going to be much more in depth and much more complicated than a residential appraisal. Whereas a residential appraisal is just going to basically throw some comps on there to what's recently traded and this and that. Whereas commercial will have, market data and tenant data and this and that. So there's going to be a lot more in-depth analysis.
Got it. What about an environmental report? What is that? And do all commercial properties require it?
Yeah, your typical environmental report is going to be like a phase one, where, really what they're looking for the most part with phase ones is like soil contamination. So for instance, like, who are your biggest culprits? Like the usual guys you're on the lookout for is like gas stations and dry cleaners. Those are like the two biggest ones. Here in Chicago, a lot of the buildings are pretty old, and a lot of times like they had these like old heating oil tanks, and instead of getting rid of them, guys would just kind of brick wall them off. And, so we'll go into properties and kind of find some of those old heating oil tanks in there, and you have to remove them, correct? Because they're contamination. But, you typically do a phase one if there's some sort of like some lenders require it. Others, they'll just do like a desktop phase one, like, hey, is there anything that's been like registered with, the county or whoever, right, the EPA for, as there's some sort of concern here. But, your biggest concerns going into there is like, you might be required to do a phase one in an apartment building if there's a gas station across the street, right? Or if it's a really old property and like in Chicago, they're worried about like old heating oil tanks or asbestos, stuff like that, right? Those are, if you're buying apartment buildings, those are the major concerns. You're buying a retail center and there's a dry cleaners, you're definitely getting a phase one. So.
I love it. What about interest rate as it relates to per asset class? Like, how do those vary?
The easiest way to explain what you should expect in like, it's hard to say like what interest rate, right, is right for every deal, right? Because some apartment buildings, you get a higher rate than hotels. But like on average, the way to look at, interest rates as a whole throughout the industry in different asset classes is by what the spread is. And typically commercial loans are priced as a spread over an index, right? So an index being, for instance, the 10-year treasury, right? And the spread being the add-on to what they get to calculate the actual coupon on the loan. So let's say the 10-year treasury is 4.5% and the spread is 300, right? So your loan rate is 7.5, right? The spread is effectively your risk premium that's attached to that particular loan. And in general, multifamily is typically going to have your lowest spreads. And anything that becomes more of a risky property or more special use, that spread's going to widen. So for instance, you would expect hotel spreads in general to be wider or larger than multifamily properties, right? And it's hard to tell, kind of like what the pricing is going to be for each individual deal. But, that's kind of the way to assume like, what price could potentially look like, when you're going into deals like this. There's so many types of lenders in general, just in commercial. There's banks, credit unions, private debt funds, private equity, life insurance companies, CMBS, government agencies. The list just goes on and on and on, right? And each one of those prices a little bit differently. Each one of those will have certain strategies they do. Each one of those, will fund differently. But in general, if you want to know like, hey, what can I expect as far as like what kind of should I expect, a higher rate or lower rate than this other property, that spread risk, calculation is kind of how to get there.
Important. And then what would you say, like, based on what you see, if you had to rank them from lower spread to higher spread, what would that look like? Like multifamily would be at the bottom. Would hotels be at the top?
They'd be up there. Yeah. The more special use you get, just in general, all things being the same, the spreads are going to widen. Yeah. Like, if you wanted to buy an office building today, it's probably going to be up there with hotels, right? Industrial, multifamily, mobile home parks, those are pretty similar. Yeah, I mean, it's kind of what you'd expect, right? So if you just know what's going on in the macro environment and kind of like where the demand is and where, the demographics are changing and like where the macro factors are, right? Like housing, huge economic support, industrial, huge economic support, office, lots of headline risk, hospitality is this quasi business investment property, right? So more risk there. If somebody's going to do an Airbnb portfolio, again, higher spreads than if you were just doing long-term rentals for residential, right? So, the less investment property looking and then, the more specialized use it becomes, I think you can expect, higher rates.
Got it. Now, I got two more questions for you.
Yeah.
One of them is we've thrown around the term of DSCR quite a bit. I know that when I transitioned from residential to commercial, that was like, what is a DSCR? I'm imagining for some of our viewers, they're feeling the same way. What's the easiest way to explain a DSCR and how do you calculate that?
Yeah, I mean, it's just debt service coverage ratio, right? And I think the concept that when people say a DSCR loan, right? Because I see that a lot in like some like the investment groups and stuff like that, is really that it's just become a commercial loan versus a residential loan. And which means you're underwriting the property first versus the person. And you're really just, it's like none of this stuff is hard, man. It's like, it's all second grade math, right? So yeah. You're just taking the net operating income and dividing it by the loan payments. And then you get your DSCR, right? And if you end up with a 1.25, so there's $1.25 for every dollar of loan payment, you're probably in the right ballpark.
Got it. So the loan payment is taxes, insurance, and loan, or is it just the like the all?
I would, yeah. So as opposed to residential, where you're gonna include all those in one mortgage payment, right? Those would be like above the line of the NOI as expenses, property tax and insurance, and then you would get your net operating income, and then figure out what your loan payments are and divide the NOI by the loan payments.
Got it. Good. So I was going to ask you is what is the state of commercial lending today? Like, has that changed at all? What challenges do you see? Like, are foreclosures going up in that space at all? Especially like in the retail, like what are you seeing in the commercial space?
Yeah. So it's changed and then changed and then changed again and then changed again. Yeah. So there's definitely a lot going on. As it sits right now, we're kind of like I don't know, feels like this week it's a little calm. But like, when rates go up and you have to readjust the cost of capital, kind of like I said before, I mean, commercial real estate is just a math problem, right? And when the cost of capital becomes more expensive, you've now adjusted one of the variables in that math problem and something else needs to adjust, right? And that's either the underlying economics of the property to increase the income or property values, right? And I mean, so far it's on paper property values. I haven't seen like people having to for sale properties at all. It kind of reminds me of COVID, right? Remember, when all that happened, people were like, "Oh my God, we're going to have all these fire sales," and this. It never happened. People held on. It kind of feels a little similar. There's a lot of people that are locked into lower interest rates, from not that long ago, right? Like beginning of last year. And, they're kind of just coasting. The underlying, like there's nothing wrong with these properties, right? Like the underlying economics are good just in general. Like the macro factors of what was going on before rates started rising are still there, right? And like the office sector, that's work from home. Rates going up had nothing to do with that, right? That's still around. It's just, if you want to do an office deal, it's just more expensive to refinance. the other parts of the economy, right? I mean, retail actually is doing pretty well, just in general, right? I mean, there's big box retail has always had its challenges. But your average kind of strip center, the consumer is good. They have discretionary income. They're spending. I'm doing a retail center right now. It's performing great. Industrial, there's huge, macro trends, that are good demand for industrial. Mm-hmm. So just in general, the property, there's nothing wrong with the property themselves. The areas where there is pain is a lot of guys got involved with very, very high leverage floating rate debt like 2 years ago. And they did these either construction or value add deals, right? And and those deals just weren't underwritten to rates going up so substantially high. And those deals are going to have challenges because most of those were syndicated deals where the GP didn't come in with a lot of money, didn't really have a lot of money. And there's nobody on the hook to come in with more, right? And so something's got to happen with those. But even with those deals, there's nothing wrong with those deals. They're just over leveraged, right? So they will sell. The equity may get wiped out, but they'll sell and people will move on. That's a lot of what I'm seeing, but I haven't really seen like forced sales, even that yet. Commercial has an interesting way of kind of like figuring out the problem. Because like as soon as it started, everybody said, oh, wow, all these deals that are on floating rate deals are going to need some sort of product. All of a sudden, there was all these pref lenders, preferred equity, which is basically like a Class A share, like a priority equity slug, to come in and pay down debt, and let these guys kind of coast for the next couple of years while the economics of the properties catch up to where the debt is, right? Commercial got an interesting way of inherently solving whatever challenge, it's having, because somebody will come in and figure out a way to make money on it.
I love it. Cool. Any final words or anything else that would be helpful to our viewers as it relates to commercial lending? And then lastly, like if somebody obviously saw value in this and they wanted to connect with you about a commercial loan, what's the best way for them to do that?
I think the number one thing I always say about commercial is, commercial real estate. And I think this helps a lot of people is approach it as a business. Like commercial real estate's an operating business, even if it's just a 10-unit apartment building. A lot of people kind of look at it like, oh, it's an investment. It's not. It's an operating business. You can't not pay attention. Even if you have a third party property manager, you can't just set this thing and forget it, right? Like the whole I'm going to mailbox money and that doesn't work. Not unless you're just investing in somebody else's deal and they're, you're just a silent investor. And I think the people that have approached it that way have done very well, right? I mean, I have a guy that whenever we talk about his tenants, he calls them his customers. You know what I mean? And I think that's like a really good way of looking at this side of the business. And when you do it that way, you get good perspective on how to operate your property, and also like how to move forward and put deals together. Also, I don't think people should over leverage themselves. If you're looking at trying to do some infinite return BRRRR thing, I think that's nuts and you should not do that. So I don't know. Less debt is better. You know what I mean? Especially with the interest rate environment we're in. Got it. That would be my 2 P's of advice. And then, how to get in touch. I mean, I'm probably the easiest person on earth to find. LinkedIn, hit me up on LinkedIn or our website, Clopton Capital, or call us directly anytime.
I love it. Well, I want to say thank you, Jake, for obviously coming on the show. Thank you for obviously sharing what you shared with us. For our viewers today, we had Jake Clopton. He talked about how a commercial loan works. We talk about commercial mortgages and financing explained. If you've enjoyed this episode, make sure to hit the subscribe button. If you feel that this episode will be helpful to somebody else, make sure to hit that share button. Thank you again, Jake. And to our viewers, until next time.